The stock market is a game of winners and losers. Some investors see the signs early, pull out before the crash, and walk away with millions. Others lose everything overnight. The question is, what if AI could see the crash before it happened? Imagine waking up, checking your portfolio, and seeing half of your net worth wiped out in a matter of minutes. Would you have seen it coming? Most people wouldn't. But DeepSeek AI claims it can. This AI scans billions of data points, watching market movements in real time, analyzing trends, and even tracking how big investors, hedge funds, and institutions are moving their money. If that's true, DeepSeek AI could be the most powerful investing tool ever created. But can it actually predict the next stock market crash? And if so, what does it say about today's market? By the end of this video, you'll know exactly what DeepSeek AI sees and whether we should be worried. But before we dive in, don't forget to hit the subscribe button and like this video if you believe AI is changing the future of investing. Right now, we are in the middle of a global AI arms race. Big tech companies are battling to create the smartest AI in history. Google has Gemini AI, designed for massive scale data analysis. OpenAI has ChatGPT, one of the most advanced AI language models ever built. China has DeepSeek AI, which is built specifically for stock market prediction. Each of these AIs has unique strengths, but only one is specifically designed to detect patterns in financial markets. ChatGPT is amazing for researching stock market trends, but lacks real-time trading intelligence. Gemini AI can analyze economic trends, but struggles with live market predictions. DeepSeek AI, however, was built to analyze stock market data, track investor sentiment, and predict market movements before they happen. DeepSeek AI isn't just looking at stock prices, it's scanning everything, from news articles to hedge fund reports to inflation data. That means if something major is happening in the economy, DeepSeek AI could see it before the average investor does. But does that mean DeepSeek AI is actually better than human investors? Or is this just another overhyped AI tool? Traditional investors rely on experience, economic reports, and gut feelings. DeepSeek AI works differently. It removes human emotions from the equation and focuses purely on data-driven patterns. DeepSeek AI scans decades of stock market crashes to find repeatable warning signs. It tracks financial news and investor sentiment, analyzing how emotions drive market trends. It also monitors hedge fund and big investor movements, because institutions always react before the general public. To see just how powerful DeepSeek AI is, let's take a real-world example. Think back to 2008. The market was booming. People thought real estate would never crash. But behind the scenes, hedge funds started quietly pulling out of mortgage-backed securities. If DeepSeek AI had been watching back then, it might have detected these early warning signs, potentially saving investors from one of the worst market crashes in history. Or take March 2020, when COVID-19 wiped out global markets overnight. DeepSeek AI, using its predictive models, might have noticed a sudden spike in panic-driven trading weeks before the market collapsed. If DeepSeek AI has accurately analyzed past crashes, does that mean it can predict the next one? To find out, I ran an experiment. I fed DeepSeek AI over 20 years of stock market data and asked it to identify the biggest warning signs before a major stock market crash. The AI's findings were striking. One of the clearest patterns it found was extreme market optimism. When investors start believing that stocks will never go down, a crash is often just around the corner. We saw this before the dot-com bubble burst in 2000. We saw it again before the housing market collapse in 2008. And we are seeing it again today. Another pattern DeepSeek AI detected was the rapid rise of interest rates. The AI found that every major stock market crash since the 1980s happened after a sharp rise in interest rates. In 2000, the Federal Reserve aggressively raised rates, and soon after, the market crashed. In 2008, rising rates made borrowing more expensive, slowing the housing market before it collapsed. And today, we are once again seeing rising interest rates. The final pattern DeepSeek AI found was that big investors, particularly hedge funds and institutional investors, tend to exit the market before a crash. These major players move their money first, while retail traders, everyday investors, often hold on to their positions too long. In 2008, banks quietly sold off risky mortgage-backed securities months before the public realized the market was in trouble. In 2020, hedge funds moved out of high-risk assets just before the pandemic triggered widespread market panic. And today, DeepSeek AI has detected similar movements. Hedge funds are reducing their positions in high-risk stocks and shifting towards safer investments like treasury bonds. That raises the biggest question of all. What does DeepSeek AI predict for today's market? To find out, I ran a real-time market analysis using DeepSeek AI. The results were shocking. DeepSeek AI's latest stock market scan found that hedge funds are quietly selling off high-risk stocks. Inflation rates are still rising faster than expected. Interest rates remain unstable, which has historically triggered crashes. These signals are eerily similar to past financial crises. DeepSeek AI currently gives today's market a 72% chance of a major correction within the next 12 months. That doesn't mean a full-scale crash is guaranteed yet, but it does mean the market is showing significant instability. If history has taught us anything, it's that warning signs always appear before a crash, yet most people ignore them. Some investors might look at this and say, "It's nothing to worry about," while others might start making changes to protect their investments now. The question is, what should you do? Should you sell everything and panic? Number. Should you start preparing and paying closer attention to market movements? Absolutely. If a correction or crash does happen, those who have prepared will be in the best position to take advantage of opportunities when the market recovers. That brings us to the real question. If DeepSeek AI has identified all these warning signs, why can't it predict exactly when a crash will happen? Because the stock market isn't just numbers. It's human psychology, political events, global economic policies, and black swan events that no AI can fully predict. DeepSeek AI can identify patterns, track trends, and detect shifts in investor sentiment, but it cannot predict the unpredictable. No AI, not even DeepSeek AI, can pinpoint the exact moment the market will collapse. That's why smart investors don't use AI as a crystal ball. They use it as a tool. DeepSeek AI is like a storm warning system. It tells you when conditions are dangerous, but it can't tell you the exact second lightning will strike. Investors who pay attention to these early warning signs have a much better chance of making informed decisions before the rest of the market catches on. This is where things get interesting. If DeepSeek AI is so good at identifying patterns, could it also predict other major financial events? Could it be used to forecast real estate crashes? Will they eventually replace human investors entirely? These are the questions we will explore in the next part of this discussion. Is AI truly the future of financial decision-making? Can it consistently outperform human investors? And most importantly, should you trust AI to manage your money? That's what we'll cover next. DeepSeek AI, with its robust analytical capabilities, could potentially forecast major economic shifts. While the potential of AI like DeepSeek to revolutionize economic forecasting is immense, it's important to recognize its limitations. AI systems rely heavily on historical data to make predictions. However, the global economic environment is continually influenced by new, unprecedented factors. Decisions influenced by AI could significantly impact millions of lives through job markets, investment safety, and economic stability. The question of accountability arises. If an AI's prediction goes wrong, who is responsible? So, what does the future hold for AI in financial and economic forecasting? As investors, policymakers, and economic analysts start to integrate AI tools like DeepSeek into their decision-making processes, we must stay informed and critically engaged. We need to ask the right questions. Is it ethical to rely heavily on AI for decisions that affect the livelihoods of countless individuals? How do we safeguard against potential biases in AI data analysis? And ultimately, how do we balance the benefits of AI-driven predictions with the need for human oversight and accountability? As you reflect on these questions, consider the role of AI in your own economic decisions and the broader financial landscape. Do you see AI as a tool for enhancing human decision-making, or do you perceive it as a potential risk to economic stability if left unchecked? Thank you for joining me in this exploration of AI and its burgeoning role in economic forecasting. Stay curious, stay informed, and as always, stay ahead of the curve.